afternoon, everyone, and welcome to the Bank's Inflation Report press conference. On my left is Dave Ramsden, the Deputy Governor for Markets and Banking. On my far right, Ben Broadbent, the Deputy Governor for Monetary Policy. And on my immediate right is the Governor, Mark Carney.
Thanks, Gareth. Good afternoon, everyone. If a week's a long time in politics, 2 years is an eternity in monetary policy. 2 years ago, at a time of heightened uncertainty, the MPC instituted a comprehensive package of measures, including cutting bank rate to a historic low of 0.25% and purchasing an additional £70 billion of assets. Today, the MPC is raising bank rate by 0.25% to 0.75%. 2 years ago, the UK economy had substantial spare capacity and domestically generated inflation was low. Business confidence had fallen sharply to levels last seen in the wake of the financial crisis. Inflation was expected to overshoot its target, but overshoot it entirely because of the sharp drop in sterling, which itself reflected the view of financial markets that Brexit would bring a large negative shock to UK relative incomes. In these exceptional circumstances, the MPC rightly chose to support jobs and activities while it extended the horizon over which inflation returned to target. That strategy has worked. Today, employment's at a record high. There's very limited spare capacity in the economy. Real wages are picking up, and external price pressures are declining. With domestically generated inflation building and the prospect of excess demand in the economy emerging, a modest tightening of monetary policy is now appropriate to return inflation to its 2% target and to keep it there. UK growth in the second quarter is estimated to have rebounded as expected, consistent with the MPC's judgment that the slowdown in the first quarter primarily reflected the weather, not the economic climate. Construction output rose in May at its strongest rate in 2 years. Retail sales grew at their fastest pace in 3 years. And broader survey indicators of output growth have been in line with the committee's expectations. In the MPC's latest expectations, conditioned on the gently rising path for interest rates implied by the market yield curve, UK demand is expected to grow at around its current pace. Household consumption is expected to grow at a modest rate, broadly in line with real incomes. With continued support from external demand, limited spare capacity, the relatively high rates of return on capital, and the low cost of finance, business investment is expected to expand at an annual rate of around 3.5% over the forecast period, a subdued pace relative to past recoveries, reflecting the drag from Brexit-related uncertainties. Although trade tensions have increased and global growth has become more uneven, global growth is still projected to remain above trend, supporting UK activity over the next few years. UK exporters remain in a sweet spot, with sterling down 17% in anticipation of a Brexit that has not yet happened. Overall, demand growth is likely to average 1.75% over the forecast, just above the new subdued rate of supply growth. That's more than sufficient to absorb the very limited degree of spare capacity that currently remains in the economy and to move the economy into excess demand by late 2019. Turning to inflation, CPI inflation has fallen back towards the MPC's 2% target since the start of 2018, reaching 2.4% in June. Above target inflation continues to reflect the effects of sterling's past depreciation as well as higher energy prices. The committee's latest inflation projection is a little higher than in May, reflecting the effect of recent rises in energy prices and the 2.5% recent depreciation of sterling. Such external factors could inject some volatility into the path for inflation in the near term. The bigger picture, however, remains one of external cost pressures easing, with the peak impact on inflation from the referendum-related fall in sterling now behind us, and domestic inflationary pressures continuing to build as slack is absorbed. The labor market is strong. Unemployment is at a 42-year low and is projected to fall a little further below the MPC's estimate of its equilibrium rate. Both the employment rate and the number of vacancies are at record highs, and job-to-job flows are back around pre-crisis levels. Pay growth has picked up in recent years as the labor market has tightened and companies have found it harder to recruit and retain staff. Across the economy as a whole, growth in average wages, excluding bonuses, has risen from around 1.75% a year during 2010 to 15 to around 2.5% in 2016, and that wage growth is expected to have picked up a little further to around 2.75% by around the middle of this year. The picture of strengthening pay is corroborated by a range of indicators. The median pay settlement recorded in the bank's settlement database has risen to around 2.5% this year, after having been steady at around 2% for each of the past 3 years. And survey evidence from our agents suggests that pay settlements will rise further this year. Direct pay indices remain well above their historical averages for both permanent and temporary employees. Although the current rates of pay growth are lower than pre-crisis averages, this largely reflects weak productivity growth. As a result, domestic inflationary pressures are rising, with whole economy unit labor cost growth increasing from 0.5% on average during 2010 to 15 to 1.75% in 2016, and to above 2% most recently. Unit labor cost growth is projected to average 2.25% over the forecast, a rate that is consistent with inflation being at target. In this environment, an ongoing limited and gradual tightening of monetary policy is likely to be required in order to return inflation sustainably to its target at a conventional horizon. In the MPC's central projection, conditioned on a market path for bank rate that incorporates around 3 rate rises over the next 3 years, inflation remains above target at the conventional 2-year horizon. And if bank rate were to remain at its new level of 75 basis points, inflation would be expected to remain above 2% throughout the next 3 years. Now, 2 issues will have a particularly important influence on the setting of monetary policy going forward. And you can guess the first, which is Brexit. It's on the front of the papers and top of the news most days. As has been the case for some time, the MPC's forecast is conditioned on the assumption of a relatively smooth transition to an average of a range of outcomes. This is not a prediction, but a simplifying assumption which broadly reflects how UK businesses and households are behaving. The committee recognizes that the economic outlook could be influenced significantly by the response of those businesses and households and financial markets to developments related to the process of EU withdrawal. And those negotiations are now entering a critical period, with the EU and UK both seeking an agreement by the end of the year. Although the range of potential outcomes is wide, what matters for monetary policy is how people react to these developments and how these reactions affect the balance of supply, demand, and the exchange rate. Thus far, British households have been resilient, but not indifferent to Brexit news. Consumer confidence has been little changed in recent months, below its pre-referendum levels, but around its longer-term average. Household spending has been increasing broadly in line with real incomes, though household borrowing for major purchases has slowed and the housing market is subdued. Financial markets, particularly sterling, marked down the UK's relative prospects quickly and sharply. Risk premia on sterling assets have increased somewhat in recent weeks. Since the referendum, business investment has picked up, but businesses have invested much less aggressively than usual in response to an otherwise favorable environment. There are signs that business sentiment is softening again, with references to uncertainty in their conversation with bank agents and policymakers spiking sharply, and concerns about Brexit reported in surveys such as the Deloitte CFO survey, now at their highest level since the referendum. Now, the second issue that will influence monetary policy setting, the equilibrium interest rate, or R-star, is as obscure as Brexit is prominent. The equilibrium interest rate is the interest rate that, if the economy starts from a position with no output gap and inflation at target, would sustain output at potential and keep inflation at target. Now, R-star isn't a direct guide to setting a monetary policy. Rather, it's a way to think about the forces acting on the economy and whether policy as a whole is stimulative or contractionary. The appropriate level of bank rate depends not only on the level of R-star, but also on the need to close any output gap that might exist or whether shocks merit varying the horizon over which the MPC seeks to return inflation to target. And as you know, the MPC published today its assessment of the factors influencing R star, or the equilibrium interest rate. And the key messages of that box are that the level of bank rate consistent with output at potential and inflation at target has fallen significantly from pre-crisis levels. This has been caused by both structural forces, such as productivity and demographics, and shorter-term forces, such as uncertainty and private and public deleveraging. Both of those have pushed the equilibrium rate down further. As a consequence, even though bank rate has been very low, the stance of monetary policy in recent years has been mildly rather than wildly accommodative. Indeed, the facts that today the economy is near full employment and core CPI tells us that the combination, and that core CPI is at 1.9%, tells us that the combination of historically low rates and asset purchases 2 years ago was about right. Tighter policy then would have led to worse outcomes now. The box also provides context to our long-held guidance that rate rises are expected to be limited and gradual. Limited because we think those structural factors that have pushed down on the equilibrium interest rate are likely to persist. And gradual because we think the domestic shorter-term factors, particularly those headwinds from uncertainty and fiscal drag, will fade slowly. As a result, R star can be expected to rise gradually, and policy needs to walk, not run, to stand still. To conclude, in recent years, the UK has faced a series of supply shocks and regime shifts that have created a set of difficult trade-offs for monetary policy. And Brexit is the most recent and potentially the most important example. But if the economy were to continue to develop broadly in line with these inflation report projections, the MPC judges that an ongoing tightening of monetary policy over the forecast horizon would be appropriate to return inflation sustainably to its 2% target. As was the case before, that judgment relies on the economic data being broadly consistent with the MPC's projections, and it relies on households and businesses and financial markets, how they respond as Brexit progresses. The MPC reminds that any further increases in bank rate are likely to be at a gradual pace and to a limited extent. The bank is well prepared for whatever path the economy takes, including a wide range of potential Brexit outcomes. The UK banking system has sufficient capital to continue lending even through a disorderly cliff-edge Brexit, however unlikely that might be. For cliff-edge Brexit risks that the private financial institutions cannot self-solve, the Bank of England is working with Her Majesty's Treasury to find solutions. Where those issues are cross-border, the bank is working with the ECB to manage them. And the MPC will respond to any persistent change in the outlook to bring inflation sustainably back to target while supporting jobs and activity. That's how we set policy 2 years ago, that's how we're setting it today, and that's how we'll do so in the future. And with that, Ben, Dave, and I, please take your questions.
Okay, as always, if you could give us your name and the organisation you represent, and please stick to one question on the first go-round. Go Ed, and then James at the back there.
Ed Conway from Sky News. Governor, you spent the last 5 years or so trying to prepare households and businesses for this moment when we're going to move out of crisis era rates to something that's getting towards normality. Do you think people, businesses are ready for this? And I kind of would draw your attention to something no doubt you've seen, which is the ONS talking about the fact that households have become net borrowers across the economy, that there might be pockets of households, particularly at the lower end of the income spectrum, who have large amounts of debt proportionally. Are you concerned about the impact this is going to have?
Okay, there's a couple ways to answer that, and I'll make a few points and then pass to Ben if I could, because it's an important issue. And the first thing I want to say is we spend a tremendous amount of time as the MPC, but also as the FPC, looking at the various cohorts of households, if I can put it that way. So highly indebted households, households who have cleaner balance sheets, households in different regions, households with a lot of floating rate exposure, households with a lot of assets, and try to determine if it's the FPC where the pockets of risk are and what can be done about them, and if it's MPC, what is the aggregate impact of any change in monetary policy on spending decisions on the economy. And we make the point, very importantly, as an MPC, is what we're looking to do is to return inflation not just to target, but sustainably to target. So we're looking to take into account those feedbacks from the change in interest rates. That's the first thing. The second is part of our guidance on, in fact, the first purpose of our guidance on interest rates, which has been twofold. One, expect interest, we've been saying this for a while, expect interest rates to go up. But secondly, expect them to go up at a gradual pace and to a limited extent, is to give households, first and foremost, also businesses, and then financial markets, some context to the type of changes that we think are necessary for that sustainable path for the economy. And we're in a situation, and you can look at it a variety of ways, but in the run-up to this rate increase, and it's been the case for a while, about 3/4 of households have expected that rates would go up over the course of the next year. Similar, in fact, higher proportion of businesses, similar expectations. Obviously, for financial markets, it's very precisely calibrated to certain points in time. Then what we do, to go back to the first point, is look very carefully at the ability for various households to shoulder interest rate increases, and of course the benefit of interest rate increases to those households who carry significant savings. It is detailed in the in this monetary policy report. Some of this analysis that we look at, and it's not comprehensive, but it's some of the analysis. I think the important thing to recognize is that since the financial crisis, over the course of the last 10, 11 years, British households, UK households have worked very hard to put themselves in a better financial position. Now that has been difficult because, as we all know, real income growth has been quite slow. But the fact is that they've paid down a lot of debt, and actually their ability to service that debt, the ability to pay debt, has improved quite markedly. And there's two, I'm going to give you two snapshots on this that are detailed in the report. But if you look at the average debt service ratio of households, it's currently well below historic averages and certainly below the peak going into the crisis. It would take another 100 basis point increase in interest rates, so a 1% increase in interest rates instantaneously to bring that debt servicing burden back to the historic average. And of course, that's a calculation that's done without any increase in households' income alongside. Now, it would be a pretty curious set of circumstances that an MPC were to raise interest rates substantially without some corresponding growth in household incomes. But that gives you a sense of it. Secondly, another calculation in there, which is important, is when you look at those households who are more burdened by heavy debt, so those who have debt service ratios above 35, above 40%, to get that proportion of households back to the historic average, not the pre-crisis peak, but the historic average, would take 200 basis points of rate increases, again, without any corresponding increase in wages. So there is a lot more capacity that, through the hard work of UK households, they have created to service those debt. The last point before I pass to Ben to talk about overall balance sheets is recognize that one thing, and the MPC is very cognizant of this, one thing the FPC did, the Financial Policy Committee did a few years ago, which is to put in place a mortgage affordability test. So as anyone here who's taken a mortgage out in the last 3 years would know, you have to be able to service that mortgage, not at the current if you 2% rate on a let's say a 75 LTV 2-year fixed rate that you can get today, but it's 7%. Okay, we just raised interest rates by 0.25%. It all fits together. The question's important, but we've got to look at it in the aggregate. We look at it as disaggregate and bring it back together. But maybe, Ben, you can just say a word on it.
I just wanted to talk a little bit about this financial balance of households, and just to remind people about the potential revisions to that number. So household saving has two bits. It has a financial bit. What are they adding to assets, financial assets, less what are they adding to debt? And then it has a sort of physical bit, new housing mostly. And the ONS stuff was about the financial bit, about the financial balance. And it's true that if you look at the latest vintage of data, 2017 is the first year for many, for 3 decades, in which that was negative. But it is certainly not the first year in which the initial estimate was negative. So I've just dug out numbers since 2000. So 17 years worth up until 2016, the initial estimate was negative on 13 occasions. So 13 out of those 17 years, it was negative. In every single year, the latest estimate is above that initial. This has been revised up 17 years in a row. And the average revision is pretty big. It's like 50 billion quid. So I've no doubt at all, it's clear that saving has fallen in the last 2 years since the referendum, and that is likely to be a feature of the data, even when they do settle down, the estimates. But I think one should probably wait till they're settled down to conclude that it's definitely negative. And that remains to be seen, I think.
Okay, Joel, and then James in front.
Joel from ITV News. So I want to stay on this subject and this theme. You've been talking about average household debt levels. The concern among debt charities in particular is those on lower incomes, who the ONS suggest are the most overextended. Step Change, the debt charity, has responded this lunchtime and is saying the wider economy can cope with higher interest rates, but it doesn't mean individual households can. How many individual households do you think will struggle to absorb this interest rate rise?
For a couple of things. One, when I went to, just to qualify a bit my answer, actually I'm qualifying your question because I went into detail. I didn't just talk about the aggregate. By going into those vulnerable households, which experience consistent experience in this economy, it happens to correspond with other economies, whether on the continent or in North America, is where households actually get into real trouble in terms of servicing their debts, is when that debt service ratio gets to around 35 and then 40%. So we spend, as an MPC, but even more so as the FPC, which talks all the time to the MPC, I can assure you, a lot of time at looking at those kink points, if you will. So we do look at exactly this issue. The other thing we do is we look at not just disaggregated data by cohorts, but we look at survey evidence in terms of ability to handle rate increases and what will individuals have to do potentially to adjust to these rate increases. And one of the issues is whether the cohort, the poorest household, what's the debt burden of the poorest households, what's the nature of the debt burden of the poorest households, and what's the impact of that. Mortgage debt, it's quite often not mortgage debt, quite often credit card debt, unfortunately, or overdraft debt. That's relatively rate insensitive. It's very high cost debt, and it's a very difficult position to be in. But the impact, the pass-through of a 25 basis point change on a mid to high teen credit card bill is relatively minor. In many cases, it's not passed on by the credit card company. But to go to the specific question, is the estimate is around 2.5% of households. This is through the NMG survey, something we run on a twice a year basis to assess precisely these issues in terms of sensitivity. About 2.5% of households would have to take quite significant action in order to adjust to a rate increase. But Joel, I'll finish on this, which is to pull it back up, is monetary policy, like financial stability policy, is for the economy as a whole. And one of the reasons why that is the case is that the pressures ultimately on inflation and the forces that determine whether the economy can get to and remain in full employment have to be addressed on the economy as a whole. And the households that are most affected by high or volatile inflation and most likely to be out of work, unfortunately, are the poorest households. So the best thing we can do, is to make sure that we're keeping inflation sustainably at target and keep this economy on track.
And then Simon.
James Burton from the Mail. Thanks, Governor. I just wanted to ask on the other side of the coin about savers. I think the last time you raised rates, only about half of the 3,200 savings rates in the country actually saw an increase, and a lot of the cases that was below base rate. What would your message be to banks in terms of passing this rate increase on to savers, and what can the bank do to try and ensure that happens?
Yeah, thanks, James. Important other, as you say, other side of the coin. I mean, savers have suffered over the course of the last decade with very low interest rates. Absolutely necessary levels of interest rates for this economy, and I think they're pleased that we're in a position where we now have people in work, more people in work than ever before. The two words of context and then where this goes. The first is that when interest rates went down to historic lows, the difference between where bank rate was and where banks' deposit rates were became compressed. So the banks were squeezed because they couldn't lower deposit rates to the same extent. They kept them positive, zero and positive. And so even though what happened when we had the first rate increase, broad brush, and Dave can speak to this, the pass-through of that rate increase was broadly consistent with historic average. That compression of the spread for banks was still there. Every time we raise rates, that becomes less of an issue. The second thing of context is that what banks pay you or I or your readers, more importantly, in terms of returns, is partly depends on how much it costs them to borrow in international markets. And that had been very low at the time of the last rate increase. What's happened from then until now is that those costs of borrowing in international market for international banks have gone up, or for UK banks, sorry, have gone up, which should reinforce the pass-through of this. Look, we, in a different side of the house of the Bank of England, we have a secondary competition objective for the PRA. We watch closely with the FCA, which has primary responsibility for this, and I know watches this very closely to make sure that this market is operating competitively, and that if your readers shop around, that they can get the best possible rates. As rates move up, one should expect more of them to be passed along. The only bit of caution I would add to all of that is the other half of our message, which is rates rising to a limited extent and at a gradual pace. And I think everybody, whether you're a borrower or a saver, needs to keep that in mind. But Dave, do you want to add anything on that?
I think what I'd add on the detail that kind of underneath the context that the Governor has given is, as we've said before, historically you never get full pass-through of rate changes to site deposit rates. Those take time. We have seen some pickup in instant access deposit rates, but it's not full pass-through. And then when you go to the wider range of savings products, you have quite a lot of different things going on. We detail this in Table 1D of the inflation report. So we have actually seen some pickup in time deposit rates more recently, and this may be consistent with the trend the Governor was talking about in terms of the pickup in bank funding costs. But when you look at price comparison websites at the moment, you do see that there's a lot of different things going on. So it's definitely worth looking at the different products if you're a saver to see how they're changing.
Okay, Simon in the middle here, and then Larry on the left.
Thank you. Simon Jack, BBC News. We've gone from 6-3-7-2 against a rate rise to unanimously voting in favour of one. And I just wonder what it is you've seen in the jobs market that has made you move so quickly? And does that indicate you're actually a bit more hawkish in that rates may have to rise a little bit faster than the gradual and to a limited extent that you've mentioned before?
Do you think I've changed my view since my opening statement? Is that the second part of the question? No, is the short answer, and I'm speaking on behalf of the committee. No is the answer to that. In terms of, I think the context is, and I don't want to get into specific voting dynamics of the committee, because when we speak here, we speak on behalf of the committee as a whole. So whatever the majority or best collective judgment is of the committee, that's our job to represent. But the view of the committee in May and June was still that limited and gradual rate increases would be required to return inflation to target. Particularly in May, given the softness of the data in the first quarter, there was this question about, as the shorthand, whether it was the weather or a change in the economic climate. The judgment of the committee was that it was very likely to have been erratic, the weather, a series of factors, but that we had the luxury of some time to confirm that view and to see if underlying economic momentum was maintained. And there were a number of indicators, even in May, that suggested that the underlying economic momentum was there, but there were a series of things that had slowed the headline numbers. And the data filled in with our expectations, not just in the job market, but in broader economic activity, and it was consistent with taking the decision that we did today.
Larry at the front here.
Larry Elliott of The Guardian. Can I follow up on that? The bank's labour market assessment is that the natural rate of unemployment is around 4.25%, and unemployment's currently below that, hence the justification for a rate rise. A former member of this committee, Professor Blanchflower, says that the natural rate is actually a lot lower than that. It could be as low as 3%. And given that Professor Blanchflower's predictions for labour market and particularly earnings growth have been recently a lot more accurate than the bank's, why is he wrong and you're right?
Where do I begin? Great respect for Professor Blanchflower, but his time on the MPC has passed, and this is a judgment of this MPC. First point. Second is that I think one bigger point of context in terms of wages, which is not precisely going to your question, I'll get to your question, but going precisely, is that given how low productivity is, wage growth that is in the upper 2s, low 3s, is actually wage growth that's consistent today with a 2% inflation target. If you have productivity growth of 1% or less or slightly above, that works out to unit labor cost growth in the 2.25 and above. We're actually seeing that level of unit labor cost growth, 2.25% labor cost growth, on various metrics. You can cut it different ways. There'll always be short-term volatility because the productivity numbers get revised. They're very hard to estimate in real time, but you can see the broad trend of that building. And now, unit labor cost growth particularly is in the range that's consistent with having inflation at 2%. And that is, if you look back over the longer sweep of the MPC's history, that has been the case. So there's a few uncomfortable new normals to reconcile ourselves with. One is that 3% wage growth. One is the productivity growth at around 1%. Secondly, a corollary of that is 3% wage growth is consistent, broadly speaking, in that environment with the inflation target. It's not the only thing that determines inflation. Thirdly, that the speed limit of the economy is about 1.5% in our judgment. And if you think about those numbers previously, pre-crisis, which is a long way back in the past, and some of it was temporary and ephemeral, but it's productivity growth of 2.25, it's wage growth of 4.25, 4.5, and it's a speed limit of the economy of 2.75 or 3%. So we're just in, we have to reorient ourselves to the current realities. But I don't know, Ben, if you want to say something about
just a
cutting
tiny
it.
thing, which is that actually wage growth is just defending the forecast here, bang in line with the forecast we made in May. Indeed, it's bang in line with the forecast we made a year ago. What's happened since then, actually, and one of the misses we've had is that productivity growth has again been weaker than we were expecting. So actually, unit cost growth has been slightly faster over the past year than we predicted a year ago.
Yeah. And we don't think that we think that, particularly in the first quarter, the very weak productivity growth is an aberration. We think that, that sort of 1.25 type rate is what it comes up to.
Francine, and then David next to Francine.
Hello, Governor. Francine from Bloomberg TV. Can I ask you about the neutral rate? How is it discussed on the MPC? How should investors look at it? If it's very long term, then how useful is it?
Well, the first thing is we have been talking about this for 4 years, at least, as the MPC. February 2014, we put out guidance, limited and gradual guidance for the overall rate path of interest rates once they increased, because of these structural changes in the global economy and the UK economy that had pushed down this neutral rate. There's been a lot of research in this institution and other institutions around the concept subsequently, and to provide some numbers around it. And what we wanted to do is to update our thinking, first point, and provide a coherent framework for analyzing it. So to get into the econometrics, and I'll just mention it and not go into detail, but using an overlapping generation model that covers the globe, also the UK, to do some of the estimations and cross-check with other estimations, including implied market estimates of where R star, the neutral rate, would be. I think so the value of that is providing more rigor to something that we have thought and talked about and guided policy and guided UK households and businesses on, first point. Second is how we talk about, and this is to go to the market, how we talk about structural and short-term factors that influence. So the UK economy, one of the most open economies in the world, is heavily influenced by the global level of the neutral rate. And the big forces on global R star, if I can use the shorthand, are demographics, aging demographics in advanced economies, and weak productivity. Big picture, those are the big forces. There are other factors, we can get into them, we list them, but those are the big things that have helped push it down, plus a degree of post-crisis deleveraging. Okay. In the UK, and in every economy, but particularly in the UK, there are some shorter-term factors that have meant that the estimate of that longer-term R star, global R star, my shorthand, is lower in the UK. Why is that? Well, the UK has been undergoing not just private deleveraging, which is largely stopped, but public or fiscal consolidation. There have been fiscal headwinds for the last several years, which continue. They're not as big as they were, but they continue. That creates a wedge. Secondly, there's a higher degree of uncertainty in this economy for reasons that everyone knows, particularly in the short term because of the wide range of Brexit outcomes. That also pushes it down. And apropos the discussion we just had, there may be a wedge in terms of productivity in the UK relative to the world. What's useful about that from a market perspective without over-egging it and over-leading? First, broad brush, markets figured out that R star is lower itself anyways. Our view of where that is, it's a wide range, but 2 or 3% nominal space, okay? Broader brush. UK below. What are the factors that influence the UK being below? Then you can make a judgment, whether you're in the market or academic, et cetera. How likely are those factors to go away? Do we think uncertainty is going to increase or decrease in the UK? Do we think fiscal consolidation is going to increase? What's going to happen to the path of productivity in the UK? Around the principal issue that occupies a lot of people's minds here, Brexit, well, it actually influences virtually all of those. And depending on the outcome, can influence them positively or negatively. And that will be part of the judgment that needs to be made when there's greater clarity about the future relationship with the European Union is what happens to those wedges between UK and global. Different people have different views both on the deal and how important that will be. But that is something, those are issues that the MPC will have to think about, and provide context at the appropriate time, because right now, I think we have similar degrees of foresight in terms of what that relationship is going to be with the EU.
David Times. Governor, just to follow up on that, there is one estimate in here which suggests an R-star of between 0 and 1% compared with 2.25% to 3.25% pre-crisis, which converts into a bank rate, nominal bank rate of 2 to 3%.
Yeah.
I know you can't be precise on this, but is there any reason why people, businesses and markets shouldn't use that as some sort of guide to the final destination once your limited and gradual rate rises have been completed?
Well, it's, and the reason they wouldn't or shouldn't go all the way to that is that the reasons that I just gave to Francine, which is that there are certain factors that, shorter term factors, which are creating a wedge between that range and where equilibrium is today. So let's bring it back to the forecast we have. We use the markets curve to do our forecast, plug that into our forecast or other assumptions, and what happens is that, and that has a little less than 3 rate increases, including the one we did today. That was what the market's judgment was. Plugging it into the forecast, and inflation is back at target at 3 years, but a little higher at year 2. Tells you something. But it doesn't tell you that R-star is up at that higher level that you just quoted, that 2 to 3 range. Okay. You don't have to run the whole forecasting model to figure that one out. Certainly you don't have to, David. But but those short-term factors I just referenced, uncertainty, fiscal, UK productivity, as those change, and if they all improve, then it moves up. That's as much guidance as one can reasonably give. Now, that's a good environment, obviously. We'd all rather live in an environment with greater clarity. We'd all rather have a higher productivity economy and higher wage growth as a consequence of that. And we want fiscal balance and, the government's on track for that. But it's also an environment where we'd be a little closer to that level, that range. But that range, last point, is much lower than the old range. Average rate of bank rates since this institution was founded was 5%. Bank rate and its equivalents. Average rate pre-crisis, the life of the MPC up until the crisis, 5%. We're talking 2 to 3. That's different. And that's different if you're a saver, and that's different if you're a business or a broader financial market participant.
Okay, Jason at the front here, and then Kat behind.
Hi, Jason Douglas from the Wall Street Journal. My question is about the global trade war, the prospects for a global trade war. Can you give us any sense of how vulnerable you think the UK might be were trade tensions to escalate? As you already mentioned, Governor, the UK is a small open economy. One of the potential lessons from history is that small open economies can sometimes get there's an outsized hit whenever protectionism rises and so on. Can you give us any sense of how vulnerable you think it is? I'm thinking in terms of the export mix relative to tariffs, in terms of financial vulnerability, some which you talked about, I think, at the FSR press conference, if that makes sense. Thank you.
Yeah. Well, the first thing to say is that in this forecast, we have put in some of the trade measures. Now, it's obviously a moving target, and one has to make a judgment about what's announced and actually implemented. But the steel and aluminium tariffs are in. The 50 and then the 200 billion U.S. Tariff actions against China are in as well, and the reciprocal actions of the trade partners vis-a-vis the U.S. are also in. So that is in the forecast. Those are in the forecast. Not last night's tweet is not in the forecast, not surprisingly, but those are in the forecast, and it's one of the reasons why global growth is a little weaker. We do observe that what we found, and as you can appreciate, that's just capturing the direct effect of tariffs. What we have seen, and it's observed in the minutes of the meeting, is that there is some tentative evidence of trade having an impact, tariffs having an impact on trade flows. You see it in capital goods orders, you see it in some slowing on trade, you pick it up from conversations. But there is not that much evidence of a hit in business confidence that's translating into less investment, I'm speaking globally, or big risk premia going into financial markets more broadly. Some specific countries obviously affected, but not more broadly. To answer your question, for the UK, and there's some simulations that we did, and it's in a speech of mine of a month ago, or 3 weeks ago in Newcastle, which is it's a fairly comprehensive analysis that goes into one chart, is that the UK can be affected by a trade war scenario and a sharp ramping up of tariffs and asymmetric response, everybody responding with the U.S. at the center. From memory, but the main effects for the UK are these confidence effects and financial market effects. So those really have to kick in for it to have a big impact, at least as it's currently happening, where it's a U.S. action and then a counteraction by the country that's affected, as opposed to a global application of tariffs to everyone. So China isn't putting up tariffs on the European Union at the moment, for example. But in that order of magnitude, it's a little less than 1% off the level of GDP for the UK. It's a simulation. 3 years out, so over 3 years, but it's more than 3% off the level of GDP for the US. So, at some point it gets to something that's material. So I can give you that sense. I would say that obviously the MPC, we spend time on these issues and look at these various sensitivities analysis, but where we land for this forecast and this decision is we can understand how it could get worse and have this impact, but we're not picking that up yet to a material degree. There's some in the forecast, but not to a major degree, given our conversation with businesses and observations. Thanks.
Okay, Kat behind, and then David next.
Hi, Kat Contigolia from Politico. I wanted to ask, you mentioned that you were working with the ECB on some of these cross-border Brexit cliff edges. How much progress have you made with getting EU officials to come up with an official solution for some of the problems around contract continuity and interim permissions?
Yeah, look, I'll give you another question if you want, because it's going to be a short answer. The reporting mechanism for that is we sit down with the ECB and other relevant regulators in the presence of Her Majesty's Treasury and the European Commission, and we have sort of real-time reporting of what the issues are, and potentially people can imagine what could be done about them. But that's the reporting mechanism, as opposed to either myself or the president of the ECB coming out and giving a detailed answer to a question like that. So.
Okay, David next door, and then Tim at the front.
Thanks. I'm David Goodman, Bloomberg News. Governor, before today's decision, a number of economists and business groups were warning of the risks of a hike at this point, given the current Brexit situation. But a discussion of those dangers seemed largely absent from the minutes, and obviously the vote was unanimous. Is there a risk this is taken as another example of BOE groupthink, and what do you make of the warnings against the policy move today?
I mean, we have robust discussions about a wide range of issues, risks, positive and negative, to the outcome, to the outlook, or to any particular policy move. And holding rates is also a policy move. Just to be clear, that's a decision as well. I think the important thing on Brexit to recognize is that there's a wide range of potential outcomes for Brexit, both in terms of the end relationship, but also in the transition to that end relationship. And in a number of those, not all of them, but in a number, what matters for the economy is not just the arrangements, but also how people in the economy, households, businesses, and financial markets react to those. That's what matters for the outlook for inflation. In a number of those potential outcomes and transitions to them, rates need to be higher. Okay, and certainly in the path where that's consistent with the forecast. So a relatively smooth, there may be lots of headlines, but a relatively smooth transition to some sort of average relationship, that we need this gentle increase in interest rates over the next few years. So we can't be handicapped or tied by the range of Brexit possibilities. And the last thing is, it's quite clear, if there is a major shift as a consequence of the Brexit negotiations that is disinflationary, has to be disinflationary, or creates a very extreme trade-off, such as one we saw post-referendum, then that could have consequences for monetary policy. But that's why we meet every 6 weeks and take decisions every 6 weeks, and we can incorporate at that time. And the idea that, it really is that simple. It's not that we don't discuss the potential range of outcomes. It's not that we don't have some view on what could happen in certain environments, but equally, we can adjust when necessary. And it is not as simple as saying Brexit equals reduction in interest rate. Okay.
Okay, Tim at the front, and then Harry behind.
Tim Wallace at The Telegraph. Governor, I know you've touched on this a little bit, but I wonder if you could expand slightly on the effect on businesses. Business groups, the IOD, the British Chambers have responded to today's rate rise by saying it's too soon. It comes at a time when business confidence is already quite weak, investment's not great, and this could make matters worse for them. Have you got any words of comfort for them, or do you think there's some reasonable worries in there?
Well, I think we have a good sense of the challenges that British businesses are facing. As I said in my opening remarks, it's detailed in the report. You can see it in our agents' reports. This is the shallowest investment recovery in over 50 years. And that's despite having relatively clean balance sheets, good access to capital, very competitive currency, very limited spare capacity, and therefore a reason to invest, and now labor markets tightening consistently, and we have investment growth, but it's relatively shallow. So we're well aware of that. The overwhelming issue for business, for most business, is the outcome of the Brexit negotiations. That's the biggest issue. There, as I said, there's a wide range. There. What the comfort we can give businesses and households is we're going to stay focused on our responsibilities. We're not conducting the Brexit negotiations. Okay. What we can do is make sure that inflation is going to return sustainably to target, and secondly, that the other side of the bank is making sure that the financial system is going to be there for British business and households, whatever the Brexit outcome is, and that's what we can do, and we will all get to the other side of these negotiations, whatever the outcome is, and we're going to want price stability, job of the MPC, and financial stability, job of the rest of the bank, and that's going to allow UK business to invest with confidence. But we can't take the time off in advance of this. These negotiations.
If we could just go back to Harry here.
Good afternoon, Governor. Harry Daniels, Live Scoop News. Sticking with the Brexit talk, really. We've seen a number of polls, the latest Ipsos Mori poll, for example, the Issues Index, showing that evidence of softer consumer confidence. It says that those that view EU Brexit as most important concern facing UK has risen to 58 from versus 46 in July, the highest reading in the index history. And 45% of respondents believe it's the most important issue. Again, some 4 times higher than the next most cited issue. I'm just really trying to get an idea of response mechanism. You said before that the MPC continues to recognise the economic outlook and that you will respond to households' business reaction as opposed to the Brexit talks themselves. Could you give some sort of framework around that response, reaction, timings? I mean, would you necessarily want to get it in front once there is a Brexit solution or conclusion? And secondly to that, again, if we do see an extension to Brexit negotiations, would that then bring forward another rate hike, say, within a period of time? That's a second question, if you like.
Yeah. I think the best way to answer that is to say that since the referendum, you can see the reaction of the MPC to two broad sets of circumstances. One in which, immediately following the referendum, you had a relatively substantial degree of slack in the economy, inflation above target, but entirely because of the view of financial markets that there was going to be a real income shock in the future, and that adjusted the level of sterling that flowed through. And we called that a trade-off, and we stepped back and said, okay, how do we manage this? Do we take the real income hit in jobs, fewer people in work as the economy as a whole? So do we raise interest rates to get inflation quickly back to target, lean against that exchange rate? And we take the real income as economy as a whole in jobs? Or do we take it in a little more inflation because we take a little longer to bring inflation back to target and we get more people in work? We chose the latter. There are limits to our ability to do that, obviously. Ultimately, we have an inflation remit, but we explain that, and it gives a sense of how we would react if there were a Brexit outcome that led to a similar set of circumstances. You know, a policy response, but within certain tolerances, and there's a track record on that, and you can look at it. Then there's the more conventional circumstance, which we find ourselves in right now, which is the economy is basically at full employment. There's very limited spare capacity. And it's a question of managing, I'm simplifying, but managing demand consistent with the growth of supply in the economy so that we stay on track. Yeah. And that tells you that depending on a different Brexit outcome, what the broad reaction function would be. But I don't want to sort of pre-wire it more than that, but Ben.
Just a very quick tiny thing, which is that consumer confidence number gets published in two forms. One by the people who collect it, and they also pass on the numbers to the European Commission. Only the European Commission numbers are seasonally adjusted. And if you look at the seasonally adjusted numbers, which we have in a graph at the bottom of page 14 of the report, they did not go down in the latest data. They actually ticked up very slightly. So, and overall, they've actually been pretty stable for the last 2 years at around average.
Yeah. Okay, the final two, I think, in the middle here, and then Jasper to conclude.
Thank you. Thanks. And thank you. Andy Mell, 5 News. Just to go back to Brexit again, you've acknowledged that it's the biggest challenge in terms of you trying to assess impacts and how people will respond. I mean, in that case, wouldn't it have been a smart move to keep your powder dry and to wait before making this interest rate rise, because we could have a much better idea of how Brexit is going to shake out even within 3 or 4 months?
Yeah. Well, look, first thing, big picture. We're finally getting to a situation this year where people's pay packets are growing faster than prices in the shops or prices online. So they're finally getting ahead. And our job is to maximize the probability that's going to continue to be the case. Keep that on track. And keep that on track by making sure that the prices in the shops and online are rising around that 2% target as wages go up. Okay, that requires some modest adjustment to policy, 0.25% interest rate rise in a timely way, and that's what's happened today. As I just said a moment ago, but it really does bear repeating, so I'm glad you asked the question, which is there's a wide range of Brexit outcomes, but in many of them, interest rates will be at least as high as they are today. Okay, so we don't need to keep our powder dry for that. There are certain circumstances that one can imagine, and I'm sure there's the ultimate Brexit outcome I can't imagine, but it doesn't matter. There's certain circumstances where it would be appropriate to either keep rates the same or lower them. If that's the case, that's what the MPC will do. But we'll do it once that knowledge is there. And the mistake is to always wait until you have perfect certainty. Because we don't know exactly when that higher degree of certainty is going to transpire from tentative agreement to parliamentary approvals, because it's not just here, it's across the channel, to implementation. And if there's important details that still need to be fleshed out during the transition period, that may also be relevant to business confidence, consumer confidence, degrees of activity. You can't just wait through all of that. If we have the economy, collectively have the economy in a position where people are just starting to get ahead, you want to make sure that you preserve that as much as possible.
So it's actually going to be two more. I'll keep you here slightly longer. It's Jasper and then Delphine at the front here.
Hi, Jasper Jolly from CCM. Sorry, another Brexit question. I know you said there are a range of possible outcomes, but one outcome that has been floated by various government ministers, including the Foreign Secretary, is no deal and therefore defaulting to WTO terms of trade. Do you think the shock from that would be comparable to, equal to, or greater than the shock that you saw after the vote in 2016? And do you think that the monetary policy response would be similar in terms of magnitude or greater?
Well, I think in terms of the monetary policy response, it will matter what, if there were a WTO outcome, is there any transition to it or not? And what's the impact in any of those scenarios, again, on demand, what happens to business investment, consumer confidence, and consumption. The supply impact we can start to figure out in terms of lost access, but also importantly the exchange rate, and it's the sum of those that will help determine the monetary policy response. I would say that all the contingency planning at the institution, which is away from the Monetary Policy Committee, so the Financial Policy Committee, the PRA, the broader institution is, as you would expect, is around a no-deal cliff edge situation at the end of March, so that as much as possible, the financial sector is dampening the impact as opposed to amplifying it, and we see that as very much our job.
Okay, to conclude, Delphine at the front there.
Thanks. Delphine Strauss from the FT. It was a follow-up question on the equilibrium real interest rate. Does the fact that this is now so much lower suggest that QE stays as a standard part of policy rather than just a tool for exceptional downturns?
Yeah, it's a very good question. I think you can look at both the guidance we gave in June and the broad guidance of the range, and it's an imprecise, but of the range for the equilibrium interest rate, and can see how the two, they're different issues, but they actually, in response to your question, can work together. The guidance on QE was that in the MPC's judgment is that we wouldn't start to think about reducing the stock of asset purchases until rates were around 150 basis points, 1.5%, as you know. And that's in order to use bank rate as the marginal instrument of policy if we needed to ease. That's obviously below the rate, potentially below the rate at which the equilibrium rate for the economy, particularly in a scenario where there's some reduction in uncertainty, some pickup in productivity in this economy, as one would hope, with, as many people have questioned, with the resolution of the Brexit negotiations, and the implementation of that resolution may be required as well. So that means if you put those two together, it means that certainly it is not necessarily the case that the lower level of equilibrium interest rates, at least in our judgment, means that QE has to remain on the balance sheet. You could envision more extreme scenarios where that might be the case, but as it happens in terms of the judgment of the committee, that's not the case, provided these shorter-term factors dissipate over time.
Okay, that concludes today's press conference. Thank you very much for coming, everybody.
All right. Sorry, I saw it.